Hey guys, what's up? Alec back with the daily stock market. And look at that, down $265 on the day, and it's Sunday. So you might be wondering, how's that possible? And that's due to cryptocurrency. If you guys didn't see, it's trending downwards on this Sunday morning and Sunday afternoon. If we go to the week chart here, though, our count is still up nearly 4%. $2,000 in the past week. So we're seeing the stock market starting to heat back up and some great gains are coming. We have a great video planned for you today. It's going to be Sunday Stock Talk. We'll go a little bit deeper into the stock, so we might only do 5 in this video and split it up into 2 videos and do another 5 either tomorrow or Tuesday. So make sure you are subscribed right now to get future notifications of when new videos are being released, and smash a like on this video if you appreciate all the hard work that I put in my channels for you guys. Okay, so the first one on the list is going to be Virgin Galactic Holdings, and let's make some money with Virgin Galactic, ticker symbol SPCE. They're down 16%, which is a huge movement for one day, and you know this stock, they're bound to bounce back whenever they move down abruptly or move down in general. They always end up bouncing back. So you see in the last 3 months, they're down 31%, which is devastating for any company to have. But if you zoom out to the bigger picture and you look at the yearly chart, you can actually see they're at a current support. All right. Now they spiked up 2 times in the last year, and they also have a resistance of around right here. So that's not even considering the big spikes, which is way up to the 3rd yellow line. So let's talk about that middle yellow line there, because that's the one that could be attractive. You know, a $20, if you buy in at a $20 entry and you exit it around $30, I think there's a good swing trade potential in there. I also think that space is the type of stock that can get some meme attention again and get continued to push by the Reddit community. Obviously, if you look at the fundamentals of space, there's nothing too much to look at. They're at a newer company for one, and two, they are rocket builders. So there's so much risk involved and expensive involved with rocket building. Because if they have a ship blow up or manufacture error, whatever the case may be, the stock can go plummeting down to $5 a share or even lower. The reason why, it dropped 16% on a day is because there was some news that actually came out about Virgin Galactic Holdings saying that they're pushing the commercial flights to space. If you guys didn't know, Richard Branson's company, he's trying to get commercial people, everyday people, residential people to space. So just like flying on a residential airline, he's trying to make residential space trips. But what happened is they actually delayed the launches for people to go to space. They pushed it back, which hurt the company's share price, obviously, which for us includes a great buying opportunity. As you can see, they've only been going up from their IPO. So I think they're a great one, great swing trade opportunity. The market cap's $5 billion, by the way. And you can actually see some people talk about, like, Bank of America cuts Virgin Galactic target price following latest flight delays, which we were talking about. And to do a quick summary on space, SPCE, Virgin Galactic stock price has been very volatile in the last couple of months, and this is largely influenced by news flow on the company's flight milestones. Obviously, it just got delayed, which caused it to drop 15%. Space could potentially generate revenue close to $400 million and be profitable in 5 years' time if it can deliver a sufficient supply of flights to meet the demand. The key downside risk for Virgin Galactic medium-term outlook are technical issues associated with space production and flight delivery, regulatory pushbacks, and stiffer than expected competition. Virgin Galactic is a hold, as I view this as a high-risk, high-return investment on proposition, which I agree with. I'm really not in them for the long term. Basically, it's a high-risk swing trade, in my opinion. So the next one we're going to be talking about today, and that's on the list to buy this week, is going to be Lemonade, ticker symbol LMND. And this is a great one. Anytime it gets to that $65 price point, I get super intrigued by something like Lemonade. 1, for a long-term hold, and 2, for even a swing trade. So it can attract both investors or traders alike. Now, with that being said, we're close to a 52-week low. 52-week lows closer to $50 per share. So I think there is a lot of potential with Lemonade, especially when they start launching more different services. Obviously, they're an insurance company. They're doing like renters insurance and some other insurances right now as well. But the big thing is that they're planning to announce that they're going to be releasing auto insurance or car insurance, which is going to be a huge revenue source. And in my opinion, that can top over $100 a share and even closer to $150 a share. So if you're looking at a longer term trade, this one can definitely 2 to 3x in my opinion. If you're looking for a swing trade, this can be around a 50% or so gain on investment, maybe even 100%, depending on how quick the news comes out. Now, obviously, we have their all-time high closer to $150, $180 per share, excuse me. And I think that we can see in the next 5 years, Lemonade being a $200 share or even $300 share stock. And that means the stock price from right now would have to around 5x. So we see the market cap is tiny right now, only a $4 billion market cap. The PE ratio there is none. It's not a profitable company. You can see that they have been getting lower on their EPS, which is not good. Here we see a summary of Lemonade is attempting to revolutionize insurance industry by removing the conflict of interest and adding efficiency to the industry. Lemonade, through product launches, geographical expansion, and efficiency, will most likely to continue the current levels of growth. Some risks include unclear path to profitability exists, but I believe long-term, more risk-tolerant investors may benefit over the course of the current decade. I believe Lemonade has the potential to become one of the biggest insurance companies in the U.S. over the next decade for several reasons. Providers today include Allstate, Progressive, Lemonade, and on the other hand, it's different. Lemonade donates any leftover premiums to charities that its customers choose, with effectively reducing conflict of interest between the companies and customers, increasing the satisfaction and loyalty of each customer. Lemonade does not benefit as much as legacy insurance companies by holding back premiums paid to its customers, therefore successfully removing conflicts and dissatisfaction. For this reason, I strongly believe that Lemonade's give back is one of the strongest factors driving the company's growth. Customers will be able to trust Lemonade more than its competitors during an insurance claim. This act may seem simple, but I believe Lemonade's give back policy creates an immense moat against its competition. First, legacy insurance companies will not be able to mimic any give back policies. So the good thing also is Lemonade has sustainable growth. Sustainable growth is one of the most important factors when investing into a small company seeking to dominate an industry. And Lemonade, I believe, has exposure, but sustainable growth for years to come and consistent production expansion efficiencies, which I agree with, because remember, they only have a few different products, which we'll get into the next section. Below, you'll see products. You know, it says right here, the number of product or services offered by a company is critical to its success, as diversified offers can drive customer growth and cross-sell amongst them. Lemonade currently has 4 products of services: renters insurance, which is 56%, homeowners insurance, which is 30%, pet insurance, which is 13%, and life insurance, which is only 1% of the revenues, respectively. These products are leading Lemonade's customer growth today at about 50% per year, as the company is attempting to make its services available across the whole United States. Okay, so they have huge growth ahead of them, because as they continue to add more products and services, they dive into auto insurance next. You know, they're having growth right now, you know, but in the next 2, 3, 4, 5 years, Lemonade is a great one to have in your portfolio and can easily 5x in the next 5 years, which is an average of 100% growth per year. Now, Lemonade's customer growth today as about 50% per year, as the company is planning to make its services across the United States, which we already talked about. Further, the company is preparing to unveil its new product, Lemonade Car, in early 2022. And I have renter's insurance, by the way. I'm buying a house soon, but I currently live in an apartment complex in Orange County, California. And Lemonade is pretty much the go-to. Everyone I know uses renter's insurance for Lemonade. It's only like, what is it, like $7 or $8 a month. Okay, so they get their premiums really low. They attract a lot of millennials because you can set it up through an app, and you can set up your renter's insurance in like 5-10 minutes. All right. Automobile insurance is one of the biggest types of insurance services in the world, with immense potential to lure more customers to the cross sell over into other things. Further, the fact that Lemonade is introducing new insurance product, Lemonade Car, in less than 2 years since their launch of Lemonade Pet, which was their pet insurance, shows that the management is executing at a high level and an extremely fast pace executing. Also see the competition below. The picture of the shows the App Store, Lemonade, Nationwide, and Progressive Insurance Company, which clearly shows extreme high customer satisfaction for Lemonade. And you can see 50,000, 4.9. This one only has 8,000, it's 4.4. And Progressive only has 3.5 star out of 3 points. So which one would you choose? For example, I'm definitely going to choose a Lemonade 50,000 reviews with 4.9 star rating. So that's just an obvious thing. Now, financial and valuation. Today, Lemonade Financial Health is strong enough to continue to support the company through the growth strategies and multiple consecutive quarters of losses until profitability can be achieved. Now, something like Lemonade, for example, is going to have, it's not going to be profitable for at least probably 2 more years because they have a lot of growth strategies and they're bleeding money right now into like the pet insurance, car insurance things, and it's going to pay off huge, huge, huge. Obviously, that's how most startups work. You're typically not profitable for the first couple of years, and then after that is where you start getting your return on investment. Now, the risks, as the potential for Lemonade is immense. The potential risk for Lemonade is immense. The risk for the stock is immense as well. Since the company is still in the early stages of growth where multiple things can go wrong, first, the insurance industry is extremely competitive market where companies consistently compete for customer acquisition. Thus, Lemonade, with its history of unprofitability, achieving positive adjusted EBITDA, may be extremely difficult for Lemonade, resulting in more dilution and further as the company seeks to raise more capital. Second, business growth may slow due to competition and the law of increasing numbers. However, despite these risks, I believe Lemonade's unique position in the insurance industry makes them a company that is very appealing. And the summary and the final thing we'll say is Lemonade is fairly new to the company, growing extremely fast in the insurance industry with a goal of revolutionizing the industry through several changes. They're a disruptive industry, including removing the conflict of interest and making insurance easier, faster through the use of artificial intelligence and machine learning. Thus, I believe over a decade, Lemonade can become one of the biggest insurance players in the world by maintaining current levels of growth through product launches, geological expansion, organic growth. Therefore, I strongly believe investors should look into Lemonade during the current market-wide correction, especially at $65 a share. You just can't pass it up, whether you're an investor for long-term or even just a trader and you're looking to swing trade up to around $80 or $100 per share. Okay, and because we went so deep on these stocks, this is the last one on the video. We're only going to be talking about 3 stocks today, but I hope you guys appreciate, when I go a little bit deeper and we can take some time to learn about some of these stocks that we're investing our hard-earned money in and not just doing guesswork. The next one up is Qualcomm, and their ticker symbol is QCOM. We have them in the past month down 5%, and in the year, you can actually see they're very close. They're actually at one of their supports, and it looks like they're bouncing back now, and they can easily be headed up to $145 again. Now, as you can see, this one might be good for option trading, doing call options or doing a swing trade on, but how we're going to play it is more of a long-term strategy because this is a great stock to have for long-term growth that can average around 20% to 30% growth per year. We also see that Qualcomm is a dividend stock with a 2.04 dividend. The PE ratio is only 16, which makes it a very attractive PE ratio. And we also have a market cap of 146 billion. So we're talking about a huge company here. Qualcomm's upcoming dividend will be larger than expected last year. So if you want to read through that, we're not going to really go over that article. But overall, in my opinion, this is a great stock to dollar cost average into for the long term and hold for the next 5, to 10 years. All right, so we'll see here. Qualcomm has positioned quite well itself product portfolio for secular growth trends in 5G and IoT, Internet of Things. A recent operation performance has been quite good and momentum should remain strong in the next quarter, supported by 5G, IoT, and auto connectivity. There are some potential issues in the short term, such as chip shortages, MediaTek competition, or losing Apple's modem business, but long-term secular growth drives are stronger. Qualcomm stock is caught in consolidation, which has been going on since January. As we saw, it's typically when we looked at the graph earlier, it's at like the support at a 52-week low, basically. When Qualcomm reached an all-time high of over $160 per share, Qualcomm stock is taking a breather before the next peak storm. Today, Qualcomm is in an extremely comfortable position. Even the loss of market shares to MediaTek does not change that. Looking to the downside risk, I see far greater exposure with many Qualcomm's other peers, especially regarding everybody's darlings, AMD and NVIDIA, which we'll talk about in another video. We'll actually compare AMD and NVIDIA, and we'll also compare them against Qualcomm, the financial sides of everything, because, we definitely like to look at the financials and do fundamental analysis too. If the general market sentiment remains intact, this is the right time to add more Qualcomm shares to your portfolio. Qualcomm's business is changing, and with it, its revenue streams are changing as well. And that's a good thing. This development is only just the beginning and will massively increase the company's footprint in the chip world over the next few years, the next decade, and beyond. The world has been straightforward for Qualcomm in the past with only two business segments. One was the licensing business, and the others were technology included integrated circuits and system softwares. It is particularly strong in sales, but less profitable. The heart of the profitability was the licensing business, okay? Qualcomm sometimes achieved margins of upwards of 87%, for example, in 2014, while margins in the technology business were only consistently below 20% margins. In the meantime, however, the margins in the licensing business also fell to 65% in 2019. Qualcomm is not the only company that can show successful products also. AMD, NVIDIA, TSM are particularly worth mentioning here, and you guys can look into some of those on your own time as well. Nevertheless, Qualcomm is seriously undervalued company to these companies. It even ranks on par with Intel, which suffered an embarrassing defeat in 5G and does not cut a good figure against AMD in the CPU sector either. And here we have a growth. You can actually see Intel, Taiwan, semiconductor manufacturing, AMD, NVIDIA, and Qualcomm on their forward 1 year. And here you can actually see that Qualcomm and Intel, which are both pink and purple, are both the most undervalued PE ratios. They have a forward 1 year PE ratio of 13 and 12. And some of the other guys like NVIDIA, for example, and AMD have a forward PE ratio of 33 and 45. Also, there's a lot of downside risk that's already priced into Qualcomm at a 52-week low. So the fact that Apple could produce its own 5G chips is already priced in here. Apple is said to account for about 20% of Qualcomm's annual revenue and about 15% of QCT and only 5% of Qualcomm for the licensing business. Accordingly, the profit side would be far less affected than the sales side. In addition, the dip should be quickly offsetted by growth in other areas. Upside potential is very real. I think especially the expectations through 2023 are meaningful, and that's where we saw a substantial increase in adjusted earnings above $9 per share for their earnings per share. That would be incredible if they reported that. In addition, Qualcomm has historically been valued at a multiple of below 17 on the adjusted PE ratio. If we take that as a fair value, we see that Qualcomm still has a decent upside potential for the next few years based on 2023 figures of the EPS being $9.5 per share. So when we assume further upside potential, that's always on the assumption that the general market environment does not change and the detriment of equities. Nevertheless, this naturally will also affect companies such as Nvidia and AMD. So the conclusion here is that there's a lot of suggestion that Qualcomm stock is taking a breather before the subsequent rush to a new all-time highs, while the prospect of further operational success and their business and consumer expansion make further improving quarters likely. The cheap valuation migrates the downside risk, creating a perfect investment opportunity. If the general market sentiment remains intact, this is the right time to add more Qualcomm shares to your portfolio. Now we see on average, the analysts have a 35% upside over the next 12 months for Qualcomm. So it's a great time to start adding to your position at $130 per share or below $130 per share. And if you sell around $175 per share, you're getting a 35% gain on your money. And in my opinion, that can happen over the next 6 to 12 months. Some analysts even have it going as high as $225 per share over the next couple months. These are all five-star analysts coming in. So Wells Fargo, we have $138 price target, which is nothing. We have $175 from more five-star analysts. We have a lot of five-star analysts coming in, even a Morgan Stanley 4.5 with $180 price target. So if we look at the 1 year chart again, they're right at that support. They bounced off it. We talked about them in one of the last videos. So if you guys already bought in around 125, congratulations on that. And continue to hold Qualcomm for long term. So I hope you did really appreciate that video. Just smash a thumbs up on the video. That's all I ask. If you got this far in the video, make sure you're subscribed and let me know in the comment section below if you like these deeper dives where you learn about these stocks that you're investing in, Qualcomm, Lemonade, Virgin Galactic Holdings, and let me know if you want me to even do a deeper dive. Let me know if you want me to do even more of a deep dive than you saw here, because we still have to look at income statements and balance sheets. If you guys want to join my step-by-step guide and my one-on-one coaching program, just shoot me a DM on Instagram. It's that easy. I'll shoot you over an application back. I respond to every single DM. And then when you shoot me back the application, I'll send you my website so you can check out exactly what you're going to be learning, the cost, and everything associated with it as well. All right, guys, make sure you share this with a friend if you found it helpful, and I'll see you in the next video. Remember, don't time the market, buy the market. Peace.